So we can hit double digit cash on cash in a rising interest rate environment, and an inflationary environment that we see today. We haven't found other asset classes where those dynamics are true.
This is your daily real estate syndication show. I'm your host, Sam Rust. Joining us today is Phillip Block, who's one of the managing partners of LBX Investments. Formerly, Phillip was a senior managing director at realtymogul.com, where he created the commercial lending business and led institutional capital market efforts. Prior to that, he was VP of corporate finance and capital markets at Centerline Capital Group, has a BBA cum laude from George Washington University, and graduated from the general course at the London School of Economics with a degree in finance. Phillip, welcome to the show. Thanks for joining us today.
Hey, thanks so much for having me. Great to be here.
So for our audience, going to set the stage a little bit. If you haven't ran across Phillip before, normally we have folks who are more embedded in residential real estate, whether that's single family or multifamily. But I was really excited to see Phillip pop onto my booking screen. We're going to be talking today quite a bit about retail, which is not something that is maybe front of mind for a lot of retail investors, no pun intended. But in my research, retail is one of the most under the radar real estate plays out there, especially over the last 5 or 6 years. Multifamily has been the sexy beast. And if you were willing to dig a little bit, maybe you went self-storage or maybe you went industrial. But there was a lot of what seemed to be prevailing macroeconomic factors that were headwinds for retail. But maybe the story is a little bit more nuanced than just, hey, the internet is here, Amazon is king, and shopping in person is dead. Maybe I'll let you kind of kick it off there, Phillip. But if there's one myth that you would like to dispel today about investing in retail, specifically shopping centers, what would it be and why?
Well, I don't want to get the word out too wide. Prices might start going up. Yeah, listen, what you just said is absolutely true. We are contrarians by nature. Rob Levy, my partner, and I think, as we understand we come out of a large multifamily platform. Centerline was largely a multifamily lender and investor. And what we've found is when everybody rushes to one side of the aisle or to one group of capital, and everybody's running away from retail or frankly any bucket, there's opportunity. And so when we set out to figure out where we wanted to place our capital personally and where we wanted to invest, this is going back 6 years or so. All the talk was the retail apocalypse and, CNN headlines about the death of retail and Amazon's taking over. And what we found is that there's nuance to that. And frankly, the last 2 years in COVID has proven out our thesis, because we're able to buy shopping centers at, we bought from 7 to 9, 10 cap type pricing, depending on the asset and location and kind of the makeup. And we've collected 100% rents. We've had a crazy leasing momentum. Almost all of our shopping centers are full. In certain cases, we're kicking tenants out and bringing in kind of better tenants or replacing things, selling out parcels. So we can hit double digit cash on cash in a rising interest rate environment and an inflationary environment that we see today. We haven't found other asset classes where those dynamics are true.
That's certainly not the case in multifamily.
No.
You mentioned on your website that you're pursuing both a value add and core plus investment strategy. And so in multifamily terms, those are very familiar. Value add, we're going to renovate units, we're going to invest some capital. And then core plus, maybe we're buying 90s, 2000s, even newer vintage in high growth markets and just kind of let them sit and work or function mostly as an annuity. What's the difference or the nuance for shopping centers? Where are you guys adding value? Is that primarily on lease up? Is that turning over tenants? Some combination of the above?
Yeah, no, it's a really good question. And you're right. Some of this is semantics and how people want to define things. I think of it in kind of overall return profile. And the way we think about frankly, all real estate investment across the board is what to us feels like an appropriate risk-adjusted return. What's the return? How much risk are we taking? For when I think about kind of core plus and value add, how much stuff are we doing? So you ask, what's the value add? There's typically what I'm looking for is in-place cash flow with some ability to some combination, push rents, lease up vacant space, or kick out tenants that are paying low rents and bring in better credit tenants with higher rents. And outparcel development and outparcel sales are a big part of what we do. Because it's really interesting, overall shopping centers with, and when I say outparcels for all your listeners, it's, the McDonald's and a Chase Bank and a Chick-fil-A sitting in front of a grocery-anchored shopping center or a Target-anchored shopping center. And the whole thing gets priced kind of as one. So maybe you buy the whole thing, including the outparcels and the boxes behind. So maybe you've got a Kroger grocery store and a nail salon and a Bed Bath & Beyond, or, pick your kind of lineup. And you buy all of that for an 8 cap, say, right? So you have positive leverage day one, you borrow at 4.5%, now 5%, 5.5%, depending on what it looks like. So versus multifamily where, you probably don't have positive leverage day one. So you're clipping high single digit type of cash on cash. And then we sell those out parcels to 1031 buyers at a 4.5 cap or a 5 cap. And so your net cap rate on what you're left owning is maybe a 10 and your leverage is still at 5%. And suddenly, you look pretty good. You're clipping 12, 13, 14%. You can refinance and get out all of your capital. It's been a nice arbitrage situation.
Yeah, finding those unique value adders is a pathway to success. And you guys have obviously found that. Do you guys tend to market those out parcels yourselves? Do you guys go through brokerage? I know there's some brokerages that specialize in those 1031 opportunities. How have you guys taken those to market?
Yeah, always through brokers. I mean, especially in the 1031 market, you got to be in it. I think every day I'd love to sell without paying brokerage commissions, but it's like, who's in the market this week versus last week? It's pretty rare, I think, for you to be able to do it yourself.
Yeah. One of my questions, Phillip, was related to COVID, and you kind of touched on this in your opening monologue, but in the multifamily side, we were all worried that our tenants were not going to pay. And then, for better or for worse, the government stepped in and guaranteed rental payments or gave massive amounts of assistance, and delinquency was never as bad as we feared and really never even concerning. It certainly dipped, but not that big of a deal. I was under the impression that retail as a whole, it really depended on what kind of retail you were in. And so it was kind of a mixed bag. I'm curious the direct impacts that you guys saw from COVID and how that has informed your acquisition strategy since.
Yeah. As I said, I mean, you're right. It really was kind of confirming for what we've been doing. And I want to be clear, retail gets painted with kind of a broad brush. There's bad retail, and there's too much retail and a lot of it. And somebody owns a lot of that stuff. And, when I say it, I'm talking a C mall anchored by JCPenney and Sears in the middle of America. That's like the fourth mall in an area with a shrinking population, right? I don't want that either. And by the way, we get asked all the time. I'm going on a kind of a tangent, but I get asked all the time, why don't you buy that and redevelop it? I'm like, to what? And then I have some investors tell me, well, we're buying this because we're at land value or below land value. And I said, what's land value? What do you mean? Isn't land value less than zero? You have to pay taxes if you can't do anything with it. So I stay very far from that. But what we saw through COVID is, I think, what is similar in a sense to multi, that you have kind of your mom and pop tenants that got some level of government assistance, and you have a bunch of service. If you own kind of good meat and potato service type guys, and grocers have done unbelievable. Like the sales across the board at grocery stores, which you'd expect, right? People can't go out to restaurants, so they started shopping more there. And what you've seen is like a Publix. I don't know if you're familiar with Publix, depending on where you are, but right, like throughout the Southeast, and the biggest guy in Florida, their sales, and they've said this publicly, they don't expect a decline back to the levels of pre-COVID. And we're seeing it because a bunch of our tenants report sales. They've done tremendously, and they continue to. So I think that what it's taught us is kind of stick with that. If you buy, Target has done tremendously. If you're in the best retail and the best locations with growing populations, a good grocery store with term, and you own shop space, that's what you want. I think where people got really hurt in retail is kind of the C malls that I mentioned and the wrong box space. There are big boxes that have struggled. There's no doubt, and that's what's made a lot of the headlines. There are boxes that do fine. But the general trend is a shrinking number of users and a shrinking size kind of footprint for those boxes. You have to be careful that you don't overpay for too much rent in the wrong size box. And I think, kind of to your point earlier, there's not that many. Like most people are familiar with multifamily syndicators and probably not retail as much. And this is hard. This is, we're professionals at this. I think kind of anybody can go buy an apartment building and get some friends to put some money in and you hire a manager, right? And you kind of clip. You can't do that in retail unless you want to lose all your money. Like you really need to be in the space every day, know exactly what the rents are, know how much it's going to cost to replace those tenants, who needs to be in that market, who's leaving the market. Those are the things that we kind of focus on every day.
Again, this is from an outsider's perspective, Phillip, but I'm always curious with multifamily, one of the blessings and curses, depending on where you're at in your cycle, is your leases come up fairly frequently. So you're able to adjust to market and your loss to lease factor is not super significant. If you're managing it well, it's easy to close that delta. I would imagine when you're buying a shopping center, a hefty part of your due diligence is going to be on the current lease file and what those look like. But are there ways where you can capture that kind of lost value if you've got significantly under market leases?
Yeah, it's a really good question. So every tenant you have different structures. The larger tenants have typically longer term leases, but even then it's 10 or 15 years with options. And there's typically rent bumps. The only guys that don't have rent bumps sometimes would be a grocer who may have 50 years of kind of flat rent, which, by the way, it's great to buy them towards the end of those because then you typically you've got leverage. You're right. It kind of works both ways. You have in the shop space, you may have 2 or 3% annual bumps. Maybe every 5 years you get bumps. So you're not experiencing the same type of annual ability to bump rents like you can in multifamily. But the other side to that is that all these tenants pay our expense recoveries. So if you think about today's environment, an inflationary environment where rents are rising, which I'm sure is what you're kind of thinking about. So in multi, you get to reset those rents annually. True. And we get some of that. But on the bigger hit, or the bigger impact in my view, and I think what we've seen historically is the expenses erode more than your gain in multi in a high inflation environment. In retail, our taxes, insurance, and CAM gets passed through. So if you're well occupied, you have no exposure to that, and all of your rent growth is kind of straight to the bottom line.
And so, that's a really fantastic way to invest in an inflationary environment. Yes, maybe you're not staying quite up to market, but if your expenses are flat and you've got fixed rate debt, I guess that would be the other key. If all your expenses truly are fixed, then you get to take advantage of that rising tide with very little downside.
Yeah, and a lot of our cash flow comes from credit tenants on signed leases. They're not, Publix is not going to stop paying you. Home Depot, Target, et cetera, they're not going to just not pay because the market stuff. And multi, we've had a 20-year run, and I get why we're kind of comparing to multi, and I'm doing it too because that's what people know, right? But we've had an unbelievable run. We'll see how that goes over the next, 5 or 10 years. It's when you buy at 3 caps and leverage at 6%, and everybody's pocketbook feels lighter because of inflation. And, if the Fed gets it wrong, which they, are likely to kind of on purpose, and you have kind of a harder landing, those dynamics can be tough in multi. I'm looking forward to hopefully picking things up in multi that are cheap because I think it's a great investment class, but, we might be in for some bumpy times.
Yeah. I remember when I first started, and I haven't been in this business very long, but you were looking at positive spreads between debt and your cap rate of, maybe 100 to 125 basis points. And then that widened out to almost 200 basis points during COVID. And now it's flipped. Most of the projects that I'm looking at, you're at least 50 basis points negative. That if at some point cap rates are going to have to start reverting back up, there's not really a way that they can stay down as far as they have. Now, there's a ton of capital out there. I think it's still a good investment class, but that's what makes retail intriguing to me is it's a little bit of the redheaded stepchild. It isn't maybe quite as easy, and yet there's significant growth opportunities in the right niches. I'm curious, how severely was liquidity affected during COVID for you guys? Just on the acquisition side, are there lenders that are comfortable continuing to lend during that process, getting comfortable with the individual assets, or was it a little bit of, a go no or no go for a couple of months there?
Oh yeah, no, I mean, we had a year, I'm thinking just about a year where we bought nothing. And
wow,
that was partly lender. I mean, I would say it was kind of lender driven in a sense, but the whole market froze. And so there just weren't transactions. Now we were cash flowing and we were doing great, but I was bored on the acquisition side. And we were talking, I mean, we looked at some public companies and making larger plays. We were talking to everybody, but almost across the country, you saw no trades during that period. I think there was the fear and thought that maybe there would be distress and opportunity. So there was some kind of element of people holding back, waiting for that. But yeah, lenders, the one major difference, multifamily, it will, at least for the foreseeable future, be supported by Fannie and Freddie. When you've got effectively government guaranteed and subsidized debt, it's a tremendous thing. And that Centerline was a large agency lender. So we were a DUS lender with Fannie. And I mean, it's just an amazing business and it provides so much liquidity in that space. You don't have that in retail. And I'm not a CMBS borrower. We are intentionally, we certainly leave money on the table with this, but to sleep better at night, we're not seeing, we don't lock in kind of long-term fixed rate and deal with special servicers just to get leverage. I'd rather always be kind of lower leverage, bank borrower, relationship type borrowers, because in retail and in commercial, things come up, right? If something pops up, I call the relationship and say, hey, this is what's going on. And we can sort through it very easily because they're all relationships. We've got big deposits with our banks and, the life companies are relationship guys. So it's been really beneficial to us now because we're borrowing 60-65%. It's positive leverage. You kind of don't need that. Whereas multi, obviously you're trying to get 75-80 maxing leverage. It's all about residual value and refinancing in the future and earning it. Most of our returns come from cash flow because we're paying 10% a year. It doesn't take that much. If you pay 10% a year, it just doesn't take that much appreciation to hit a pretty good return. Frankly, none. You did just fine.
Yeah. Most people, if you told them you were going to get 10% a year, they'd be thrilled.
Yeah. And tax adjusted, it feels really good, Do
you guys do cost segregation studies on your?
We do. I wish I understood anything about it. You get it back and they figure out how, what the lifespan of the doors and the windows and stuff, I guess, on these shopping centers. But it's amazing, especially after the last tax reform. I mean, you take most of it in the first year. And, that's typically 3 years of income that you take as a loss in the first year. I mean, it's unbelievable.
Yeah. The bonus depreciation, a lot of our investors, it's one of the primary motivators for them to get into real estate is the fact that they can shield quite a bit of income, especially if you qualify as a real estate professional. So that's a key. So Phillip, you've done quite a bit in the real estate world. What's been a key to your success over the years?
Man, that's a good question. I would hope for more success. I don't want to think of myself as too successful just yet. But honestly, there's different pieces to it, I think. But fundamentally, partnering with good people like Rob, Rob's just a close friend and a great guy and has a ton of experience too. And working with people that you like and trust and do the right thing and buy good pieces of real estate and put on the right type of leverage and you do just fine. And, stepping aside from that, I think everybody's done pretty well over the last 10 years or so. And, real estate is fundamentally kind of gone up. But if you buy good real estate and you don't over leverage it, you do well in all times, right? You weather bad times fine. And in good times, everything's great.
Yeah. And then last question, you're obviously dealing with a little bit different sector of the broker market than the rest of us, but how are you finding deals these days?
Yeah, that is the one. It's interesting. Certainly in other sectors, you can find some off-market stuff. And we've occasionally, we are buying institutional assets. So I'm almost always buying from public REITs or large private equity funds or banks, like pension funds on occasion, that type of seller. And they, across the board, will never sell direct or historically have not because they've told their investors they're going to go to market and get a market price, and it doesn't look good for them if they don't. So we've got really good relationships with, it's JLL and CBRE are kind of the big guys across the board. And then there are, in local markets, there are occasionally guys who do pretty well. But kind of fundamentally, those are your two largest shops. And we're normally competing with 5 people, 3, sometimes 8, sometimes. It's not multi over the last few years where it's, they send out an OM and there's 1,000 people signed up and 100 bids. So that works to our advantage. And we're one of the few kind of consistent guys who we've never not closed on a deal we put under contract. They all know that. We've been one of the more active groups in our markets. And so we kind of get a first look, an early look, and a lot of intelligence from the brokerage community.
That's fantastic. Well, Phillip, thanks for joining us today. It's been a pleasure to have you learn a little bit more about this underappreciated asset class. If folks want to check you out, learn more about what you're doing, how can they reach out to you?
The easiest way is our website, lbxinvestments.com, and my contact info is on there. Reach out anytime. We'd love to hear from people.
Fantastic. Well, thank you, Phillip. Thank you to our listeners for joining us. This is your host, Sam Rust, signing off.
Thank you for being a loyal listener of the show. Please subscribe and share it with your friends. We want to help you become the passive investor you've always wanted to become, but also the operator you've always wanted to become. We want to be the number one resource for your real estate investing journey. But go to lifebridgecapital.com where you can start investing in real estate today.